So today I've compiled a list of the most frequently asked questions regarding 1031 exchanges. So let's get into it. A 1031 exchange allows you to defer capital gains tax on the sale of investment property or property used in a trade or business. It allows you to maximize your dollars that you can use to reinvest into another like-kind property. So really any taxpayer can qualify for a 1031 exchange, whether it's you individually, you and your wife, an LLC, a trust. They all qualify for a 1031 exchange. The big thing is obviously you want to make sure the property is held for investment or used in a trade or business, because that is what satisfies one of the 1031 exchange requirements. Really any kind of real property, so whether that's your single family home, your duplex, apartment complex, quadplex, vacant land, your working farm, your commercial building. Those are all types of properties that can be transferred or used in a 1031 exchange. So you're looking at the character and the nature of the property. So like kind for a 1031 means that you are looking at the nature and the character of property. It doesn't necessarily have to be identical. I don't have to necessarily sell a single family home for a single family home. I could sell a single family home for a condo. I could sell vacant land for a commercial building. So that satisfies the like kind requirement for the 1031 exchange. So really there's the two big timelines. So everything starts from the day of closing of your first relinquished property, or selling more than one property, or just the relinquished property. Within the timeline, you have your 45-day identification period, in which you're used to identify properties that you would want to acquire to complete your exchange, following certain identification rules. And then you have your 180-day exchange period, in which anything that you've identified should be acquired by that 180th day. And again, everything starts from the day of sale of your relinquished property or your first relinquished property if selling more than one property for exchange. Large rule, you can identify as many, but we want to look at certain rules that go along with that. So if you're looking at the 3 property rule, you can identify up to 3 properties regardless of value. If you want to identify more than 3 properties, we then go to the 200% rule, where you can identify 4 or more properties as long as the total value of all the properties identified, the aggregate value, doesn't exceed 200% of the sales of the value of the property you sold. If you go over that 200%, that's fine. Then we look at the 95% rule. You know, it's a rule that's not often used, because the 95% rule says that if you identify more than 200%, the IRS says then you have to acquire 95% of the value of the properties identified, which in essence is all the properties. So a qualified intermediary is someone who helps facilitate the exchange. They're going to enter into the exchange agreement with you and the escrow agreements. They're the ones that you are going to assign the contract for the properties to, which is a huge part of the 1031 requirement. They help facilitate the exchange for you. So it's needed to not only enter into those agreements, but they're also used then to hold the funds that are from the sale of the property. One of the big things with the 1031 is having receipt or constructive receipt of funds, which you can't have. And so the qualified intermediary is the person that does that for you. So yes, everyone, one of the misconceptions is that a 1031 is an all or nothing, and that's not the case. So at closing, you can take cash out if you're looking to do a partial 1031. And so the cash that you've taken out would be considered taxable. So, but yes, you can take any kind of cash out, whether you need to or not, for that, but just knowing that portion, since it's not reinvested into a like-kind replacement property, would be considered taxable. So the IRS is very strict on their deadlines, both for the 45 and the 180. After the 45th day, you can no longer identify any property. So we look at what you've identified, which then determines how the exchange is going to get completed. And you must close within the 180 days. If you fail to close within that 180 days, then the exchange is no longer a valid exchange, because you didn't meet the guidelines of the 45 or the 180 in those cases. Yeah, so the costs with the 1031, obviously you have the qualified intermediary fee that comes with that. So that can range anywhere just depending on what you're selling and along those lines there. But on top of that, obviously if you're doing any kind of real estate transaction, you also have any kind of legal fees that might come in there, title, escrow fees for closing, along those lines there. So but for the basic part of the 1031, it is usually a separate fee for the qualified intermediary along those lines. So yes, you can, but the IRS does have a little bit more of a strict rules around buying and selling from a related party. and they do that to ensure legitimacy of the transaction. So, but you can do it along those lines, but there's certain rules that need to be followed with the related party aspect of buying or selling as part of the 1031. Yeah, you can. We call it a swap till you drop. So as things stand now, you can continue to do a 1031. There's no limit on the number of 1031s you can do over the course of your lifetime. And we have, clients, they use it as part of their estate planning. They do 1031s when they pass, then their heirs get the stepped up in basis that can occur with that. So, but there's no rules around how many 1031s you can do, and so people have been doing them their entire life, still deferring that tax. And that right there wraps up the questions that I frequently get. So if you have any other questions, drop them in the comments below, and thanks for watching. See you next time.